Information shared on the following program is for general information purposes only. It does not constitute legal, tax, investment, or other advice, nor is it intended to recommend any particular investments, products, or financial instruments. Always seek advice from your financial advisor, attorney, or accountant with regard to investment, legal, or tax questions.
I'm sure you've heard the old saying, what goes up must come down, but I bet you haven't heard this one. What goes up might just one day flatline.
Welcome to the only show in the country dedicated to helping savers worry less about money, the Worry-Free Retirement, with your host, retirement specialist and six-time author and fiduciary, Tony Walker.
Retirement. It's kind of a funny concept when you think about it. In the annals of history, this whole notion of stopping work at some predetermined age and never to work again is relatively new. As I covered more than 20 years ago in my details of the documentary Say Goodbye to Granddad's Retirement, prior to the creation of Social Security in 1935, most hardworking Americans didn't even think about retiring from work. No, they just kept working until they no longer could work. Well, not so today. With the invention of Social Security, the replacement of guaranteed pensions with employee-funded 401k plans, and people living longer than ever before, retirement, and the many financial institutions are now jumping on the retirement planning bandwagon, is all you hear about, which, seeing as though we've specialized in retirement planning longer than most, is fine by me, as it keeps us in business and allows us to serve the needs of thousands of savers who are already retired or thinking of retiring in the very near future. Yet, there's a problem. How does a saver who has been saving all of his or her life all of a sudden stop working for a paycheck and then try to figure out how to turn that 401k into one? And of course, all the while, not running out of money in retirement. Well, I'm certainly glad you asked. Well, welcome, folks, to the Worry-Free Retirement. And yes, I'm that little man in the sweater vest, retirement planning specialist and the world's friendliest financial fiduciary, Tony Walker. And today we're going to address the most common questions we receive from savers who are already retired or thinking of retiring soon, and how we at Tony Walker Financial more specifically address their concerns over having too much money in the stock market during this thing called retirement, and of course falling victim to what I call the next flatline effect of the stock market. But before we dive into this subject, let me introduce two young lads in the Worry-Free Studios who better not flatline on me just yet. America's favorite financial sidekick, Mr. Aaron Orender, along with Louisville, Kentucky's most laid-back graphics artist, Mr. Derek Hudson. Okay, let's get back to the original question I asked at the very beginning of the show. Have you heard the old saying about the stock market? What goes up must come down. You have? Well, that's good. So, what that means is with anything in life, if you toss something up in the air, gravity will eventually pull it right back down. And as we can see from this graphic of the recent history of the stock market, you can see that the stock market has followed this rule of gravity on frequent occasions. But I bet there's something you did not know about the stock market, and that is something we call the flatline effect over time. Look closely at these years between 2000, a major decline in the stock market, all the way until we get to the year 2015. Notice that if you had money in the stock market in 2000, over all that roughly 15-year period of time, with gravity bouncing the market all around like a yo-yo, 15 years later, you would still have the same amount of money. In other words, your overall returns flatlined, leaving you with less money than when you started when you figure in the effects of inflation over that same period of time. So what does this flatline effect have to do with those of you who still have most of your life savings in the stock market? Well, when I return, myself and our own Wes Walker will tackle some of the most common questions we receive each and every day from savers who are worried about having too much in the market during retirement, and what can happen to the amount of money they now enjoy if this market flatlines in the future. So if you're retired or retiring soon, worried about that money in the stock market, and don't have a game plan in place for the future, stay tuned because this is some good stuff coming up. I'm Tony Walker. This is the Worry-Free Retirement, and yes, we'll be right back. This Tony Walker Financial 5-star review comes to us from Brent. Had been with a captive planner for several years, but felt they had grown complacent and the fees were too high. We never thought we'd do business with a TV radio advisor, but we'd caught some of Tony's broadcasts and he definitely made sense. So we gave him a call, sat down in person, had him prepare a game plan, met his staff, and decided to give him a go. Great decision. Their customer service is outstanding and we are pleased with the results. Granted, this is a saver portion of our portfolio and he is not the firm for risky investments, but he will tell you that up front. In addition to the financial side, Tony's philosophy of live well, die broke, he really doesn't mean completely broke, woke us up to the fact that we should enjoy money while we still can and not be held hostage worrying about it. If you'd like to read more of our 5-star reviews, simply log on to TonyWalkerFinancial.com.
Who can you trust? It's one of the most important decisions you'll have to make. Question is, are you ready? Well, we're here to help at Tony Walker Financial. You know, we care more about you than we do your money, and we have over 3,500 happy clients and an A-plus rating with the Better Business Bureau to prove it. Rolling over a 401k, confused about Social Security, maybe you're afraid of running out of money. Learn how to use and enjoy and protect your hard-earned money. Log on now to TonyWalkerFinancial.com and let's get started. To the average saver I meet looking to retire, or in many cases, the savers I meet who are already retired, figuring out how much money, if any, to invest in the stock market during a period of time where they will be retired from work is a scary proposition indeed. That's because savers realize that while nobody can predict what the stock market might do in the future, we can all agree that over the past few decades, there was a period of time between 2000 and 2015 where the market is what I referred to as flatlined. In other words, between that period of 15 years, after factoring in the effects of inflation, one would have lost money by leaving it in the stock market. And it's not just the money you could have lost, but one must assume that if you are retired and not working and dependent on this money to live on, if we do experience another major market downturn in the future, what will the effects be on that money, and how could a future flatline determine if the money one has saved will last as long as you do? Not only is this a scary proposition to consider, but it is downright confusing when most savers I meet are listening to way too many voices on the matter, many of whom are not experienced nor trained in the art of retirement planning. Whether it's the many random strangers on the internet doling out retirement investment advice, the advisors hosting dinner seminars or pseudo-college classes, and yes, even folks like yours truly who are on radio and TV touting their expertise, the thousands of savers I've met in the past 41 years of doing this business still ask the same question. How much money in retirement should I invest, if any, into the stock market? In almost all cases, the problem is not that they don't have enough money. The problem is none of these people have a written game plan, and therefore, not knowing what to do with this stockpiled money, most continue to blindly risk it in the stock market, which of course is no plan at all. So to help us in this matter of better understanding what could happen in a flatlining stock market is fellow fiduciary here in the Louisville office, Mr. Wes Walker. Good morning, Wes.
Good morning, Tony. How are you?
I'm doing great, and thank you for being on. We got a little bit of a limited time. We're kind of running short, but this is a crucial topic because, as you know, I've been here, almost 6-7 years? Or
It'll be 6 years in January. Been here a little while.
And you've talked to hundreds of people. This whole question of how much, if any, should I invest in the stock market during retirement is a biggie. So what I wanted to do with you, because you're taking a lot of questions from current clients, is just go through a few of the common ones. So let's get right to it. I like this one. What is the stock market, and why would anyone invest in the stock market in the first place?
Sure. So the stock market in general is just kind of this big amalgamation of different companies. You can think of it as all the companies in the United States or a foreign land or whatever that, index is tracking, all lumped together. That's, in theory, the stock market. Now, to expand beyond that, in the short term, stocks are like voting machines. People vote for their favorite companies. You see these companies run up in price. They have really great returns in the short term because people are voting for them. In the long term, though, the stock market is a weighing machine. It takes those companies that actually have had great results and promote them into higher highs rather than just public opinion as it does in the short term. So it's a very complex thing. It's very interconnected, but basically it's just companies in America and abroad.
That's a very good explanation. Okay, I like this one. Here's another question you pose, and you hear this a lot. When someone loses money in the stock market, where does that money go?
It's an interesting thing to think about. You would think that if you've lost money, that means maybe somebody else has made money, or that you've somehow gotten the rug pulled out from under you. I would think about it like this, if you bought a home and all of a sudden there was some problem in housing and the value of your house could not sell for what it would prior, you didn't really lose any money. You did, of course, on paper, but it's just that the value of that asset is no longer as high as it used to be. So that same principle applies in the stock market. If you've got a basket of stocks and all of a sudden investors aren't willing to pay as much for them as they were prior, you've just had a paper loss and it's not worth as much as it was.
No, I like the homeowner analogy. That's a good one. Okay, so we got a couple of articles to cover. Now, remember, our theme is, Wes, this whole idea that the market is always perfect, and it's not. We see it goes up and down. Then we've talked about this concept of flatlining. Well, what's this recency bias all about? This comes to us from Charles Schwab.
Sure. So what finance has moved a lot toward lately is what's called behavioral finance. And it's not so much about the technical numbers behind everything. It's more about the psychology of money and investing. And this is one of these biases that a lot of people have expounded on. Recency bias just tells us that, you might become acclimated to a certain climate and think that that is going to continue forever, when in reality, it may not. So if times are good, people kind of get that feeling in the back of their head like, oh, this is just the normal. It'll always be like this. But that's kind of the scariest words in investing or personal finance is this time it's different. Things can always revert back to worse times, and in bad times, things can go back to being better. So recency bias is definitely something to look out for when investing.
I like that. And then you picked another one here, understanding sequence of returns and risk. And again, let's try to stay in our theme of somebody retiring. What's so important about this?
Well, sequence of returns risk is just a fancy way of saying catching a bad run. So like 2000 through 2002, you had negative market years, during that period. If you retired right prior to the year 2000 and you're watching your money go down year after year after year while you're taking withdrawals from it, that is just a recipe for disaster. And that's what really sequence of returns risk is. If you catch a good pocket in there, like let's say the 2013 bull run through 2016 or whatever, just a good few years, your numbers are going to look very, very rosy because the returns are high. You can take out distributions, you can increase your withdrawal rate, but if conditions are bad, that does present some sequence of returns risk just because markets aren't great.
And that's kind of happening right now, wouldn't you agree? Because we've got a pretty good run as we record this show in October 2025, but and that's only like a 3-year run. And was it 2022? We had a pretty good little hit to the market.
There was, but even that one was, it wasn't the biggest drawdown we've ever seen. So in recent memory, people forget about times like 2008, 2001. You can go all the way back to the 1929 Great Depression. These things can happen. And I think if you're not well suited for it in retirement, if you're not prepared with an income plan, a game plan, it's really hard to navigate those kind of waters. So this is actually the NASDAQ. So this isn't the S&P. This is more of a tech index. But if you looked and just said, hey, in the year 2000, if I popped all my money into the NASDAQ at once, it would be 15 years before you got back to even. And that's sequence of returns risk.
I got you.
So these kind of things can be mitigated by things like dollar cost averaging, annuity contracts, retirement income planning. That's what our focus is really making sure people can use their money in retirement.
Well, Wes, thank you so much for everything you do for our clients and answering all their questions. Folks, we'll be right back. Having worked in the retirement planning field for 40 years, I know it's not just about how much money you've saved for retirement, but making sure you one day don't run out of money. That's where Mailbox Money comes in.
Mailbox Money!
A reliable, lifelong income, much like the pension plans from the past. If you're interested in turning your 401k into Mailbox Money, let's talk. Just set up your free 10-minute phone call with myself at TonyWalkerFinancial.com. That's TonyWalkerFinancial.com. Warning. A licensed insurance agent with no prior knowledge of annuities can legally toss your 401k into an annuity. Don't make that mistake. Log on now to TonyWalkerFinancial.com before ever purchasing an annuity. Welcome back to the Worry-Free Retirement. And before we continue our discussion on what goes up might just flatline, over the next 7 or 8 minutes, stay tuned. But also following this segment, I'm going to share a little interesting tidbit on what the Bible has to say about this whole idea of being flatlined as well. So good stuff coming up. But before we get to the Bible segment, In the studios, as we continue our discussion on this idea of the stock market flatlining in your retirement, is Mr. Wes Walker, who was on earlier, and then we brought into the studio Mr. Trey Juergens to help us kind of discuss this further. Good morning, Trey.
Yeah, good morning.
All right, so Wes has covered in great detail some great explanations of this whole idea of being flatlined. But I really want to go back and really dissect, and I know this is the NASDAQ, Wes, and for those of you listening on the radio here, obviously you can't see this, but roughly what we're saying is between 2000 and the year 2015, the market was just all over the place, up and down and up and down. But if you look at just that 15-year period, basically you would have made no money. So you caught up on where we are on this trade.
I'm tracking.
Okay. So my concern is, again, folks, if you're listening to this show, we are a retirement planning firm. The majority of our clients are either already retired or nearing retirement. Normally we don't work with 35 and 40-year-olds who are still in accumulation mode. We're at that point in life where people are wanting to use and enjoy this money without the fear of one day running out. So as you glance at this real quick, Trey, I know you meet with a lot of people who have decided to do business, and they come back to meet with us, and we're talking to them about how much they really want in the stock market. What comes to your mind when you think of the possibility in the future that we could flatline a stock market for 15, 20 years and somebody's needing money out of this thing?
Well, just looking at this graph and understanding our saver clients, and to be 100% in the NASDAQ anyway for our clients, they'd have heart palpitations. So I do think it is amazing to really understand the saver's mindset and knowing, just playing the stock market game and being that aggressive for so many years, just to be back where you started 15 years ago, they would laugh at that.
Yeah, and so Wes, take us through the thought of this. Let's just say, and again, folks, we're not trying to scare you to death. We're just trying to be practical, and we're going to emphasize again before we get off this segment how important these game plans are that we create. But let's kind of fast forward, Wes, and imagine somebody's retired, and they do have a nice nest egg. They've done well in the stock market, but what happens when they start drawing money out if we go in through one of these flatline periods? What could happen to their accounts?
Going back to what we talked about prior, there's that sequence of returns risk. So if you're not making any sort of return on your investments, or they're going down while you're making withdrawals from them, in real terms, you're effectively losing money. The replacement rate's not there. You're not earning enough to replace what you're taking out, or even close. If it's going down, obviously you're losing money on both ends. You're not only withdrawing from the account, but the investments themselves are losing money. So it can be a real precarious situation to be in, particularly for somebody who is not suited for a lot of risk. If they're a saver, that would be a nightmare scenario for them in retirement.
Well, and I want you all to weigh in on your thoughts on this, because it is interesting when people come to us, we can tell that they are just, maybe they've done a great job in the stock market and their 401ks are up there, but we know they're nervous about it. They understand intuitively what can happen. So I want to reread a Tony in the Trenches I read it in the show, would get your thoughts on this. This came from Dave out of Bowling Green. He said, recently was very frustrated with my advisor, had a great relationship with the advisor, worked with him for years, and wanted to move to safer territory. Basically, the advisor said, no, I'm not going to do that. You're going to stay here. That's what got you here. And he basically said, hey, I'm 65. I don't want to take all this risk. And he asked me, he said, okay, if I ask you that question, if I'm a client, how are you going to respond? Are you going to have that same response and tell me what I can and cannot do with my money? Wes?
Well, it's the person's money. I mean, to tell them they can't make changes with it that's out there. What I would say is that if this person is 65 and is about to retire or is already retired, and markets are at highs, and why would you not at least entertain the idea of reducing risk in some way? Maybe not cutting the equity exposure to zero, but backing off on it to some degree. The last thing you want to do is, knowing that this person has this, sort of mild risk tolerance, the last thing you want to do is keep them in this position, wait for a market downturn, and then when it really is crunch time, watch that person realize a loss, because now they're going to get out of the market. I mean, if you're going to do it while the getting's good. Make hay while the sun's shining.
That's a great point. So, Trey, your thoughts on this situation?
Same thing. It really comes down to just knowing your client and going through our process. We really do get to get a feel for their risk tolerance. And if the advisors point at these great returns and saying, look at how well I've done for you, so what? If they're terrified and this market does take a turn for the worse, you're putting your client in a really bad position, especially right at the retirement line.
And speak to, Trey, the game plan and the confidence. You do a lot of deliveries. In other words, folks, what we do in our process, if you are eligible to go through our process, which again is absolutely free, I lay out the game plan. Our income planning department puts it in our proprietary software. We go over it in detail. We're very low key. We go at your speed. Eventually people, most of them will say, yeah, I'm ready to move forward. So they come in, we move all the money over. Then you, Trey, in most cases, you or Heather in the Bowling Green office, sit down and go over that binder. How comforting is it to know that they've got the game plan? And really and truly, how much do those conversations even get into rate of return?
Very few conversations are driven by rates of return. We have so many people that come in and we see these 401ks that have done 20, 25% year to date rate of return. And then they're way more warm and fuzzies when we sit down with a game plan and show them they've got lifetime income that's guaranteed for the rest of their lives. So they're not chasing those returns. These saver clients, they really just want to know that they've got enough to pull this retirement thing off.
And then Wes, you talk to so many people who now, let's kind of fast forward, maybe been clients for 1 or 2 or 3 or more years, and they're checking in on their accounts. And what flexibility do we give them if, let's go back to that situation where they say, hey, I'm ready for more risk or less risk, depending on the market, and the way we've built out our strategies and to make sure it's very cost effective to move in those strategies if we need to.
Definitely. To talk a little bit about our investment, philosophy or the way we build out our strategies, there's no trade fees. There's no costs to get in and out of the strategies. A little bit of a divergent point here, but I've seen more and more advisors using what they call alternative investments like private equity, private credit. It is very illiquid. It's very hard to get out of those things. So if you've not committed yourself to that for the foreseeable future, you're not really going to be able to get out of it. So we build the strategies very intentionally to be very liquid, to be very nimble. You can change strategies if you want to, but I think that decision to change from one strategy to the other needs to be done with the help of a fiduciary. Make sure, you're thinking about this the right way. Ultimately, we will do what the client asks us to do, like in the example that you gave. But I think to have that second set of eyes and somebody who's seen a lot of retirement plans play out to get their advice before making those changes is imperative.
Yeah, well said in both accounts. So folks, if that's you right now, maybe you're sitting there, you are retired, retirement's just a few short years away, and you really are wondering, hey, wait a minute, if I got way too much money in this stock market, and if we like to say, if you could accomplish all of your goals and objectives without taking all this risk, why not at least take a look? We can give you a free second opinion. Just log on to TonyWalkerFinancial.com. That's TonyWalkerFinancial.com. Click on that Let's Get Started or call us 24/7. We'll be happy to set up that free phone call with myself. That number is 877-499-9255. We'll be right back. Have you recently retired, been laid off, or offered a buyout? Has the company you work for moved, been acquired, or closed its doors forever? And finally, do you have a 401k with a previous employer you'd like to move to safer territory? Then take advantage of this opportunity to move your 401k or lump sum pension to Tony Walker Financial. Let's meet in person to discuss your retirement options. Log on now to TonyWalkerFinancial.com to schedule your free, no obligation appointment. Let us help you today.
Welcome back to the Worry-Free Retirement with the money missionary himself, Tony Walker.
Our theme today deals with this interesting phenomenon of what I call the stock market flatline effect, a period of time where the market will go up and down, but over time doesn't really make any money at all, as we saw between the years of 2000 and 2015. Which leads me to discuss this Tony in the Trenches from Dave in Bowling Green, who shared his frustrations with me about his concerns of leaving all of his money in the stock market during retirement. Here's what he had to say. Tony, I recently got frustrated with my current advisor who I've worked with and enjoyed over the years when she would not respond to my suggestion to move me to safer territory. I reminded her that I'm 65 and I want to play it safe from here on out, but she refused to change my investments. How would you respond to such a request if you were my advisor? First, as a fiduciary at Tony Walker Financial, we are always going to do what our clients tell us to do. Now, that doesn't mean we might question them to be sure they have thought through what they are asking, but in the end, this is the client's money. And if a client is fearful of the stock market and tells us they want out, we are going to respond immediately and get them out of the stock market. But more importantly, since we are dealing with savers and know that during retirement they do not like to take a lot of risk, we're going to rely on a retirement game plan to guide us as to where to invest this money, not just blindly throwing it in the stock market and hoping for the best. This philosophy, which is so different from the rest of the financial herd, is not only born out of working with thousands of savers over these past 41 years, But it is, in my humble opinion, a very biblical approach to investing one's life savings, especially when one is retired. Because the real question is not how much you should stockpile for a future that is uncertain at best, but how much do you really need to live on in the first place? That's the real question, and one that most advisors and big financial institutions do not understand. And where does a right understanding of God's take on retirement and how much we should have stockpiled for the future begin? Well, it begins with simply focusing on today and making sure you've got today covered. Check it out in Charles Spurgeon's morning and evening devotional, where Spurgeon reminds us of this daily truth where he says, "Sufficient for the day is all that we can enjoy." Translation according to Tony, you only need so much money for what today is requiring of you. And the beauty of leading our own life and setting our own spending goals is this. You don't need me or any other so-called financial expert telling you what you should spend and what you should spend it on. No. What you need is a daily dose of faith that what you have is sufficient for today. I think this is why Jesus had to remind us of the birds of the air and how they focused on God providing for them each day, which He does each day. But still, while today's dollar might be sufficient for today, we also, like the birds of the air, must be responsible for either working for our food or relying on what we've saved to provide the daily sustenance we'll need in the future. And that's where being logical and practical with your money comes in, especially if you are a saver. Folks, just because you made a lot of money in the stock market in your 401k over the years doesn't mean you'll have the same positive experience by staying in the market during your retirement years. And the market flatlines while you're taking money out to live on, well, one day you could run out of money, which I don't think is what God is encouraging us to think about. So how does one strike a balance of investing for the future and spending money as God provides us each day to spend? Well, let me share with you the key to being worry-free in retirement, and here it is. Number 1, know what you have to work with. Number 2, get a written game plan to see how the numbers will play out both today and over time. Number 3, assume that you will not take a lot of risk with your money and therefore only assume very realistic and modest returns as you project into the future. At Tony Walker Financial, we like to use the rate of return of 3% just so we can be very conservative on our numbers moving forward. Number 4, take on the philosophy of Live Well, Die Broke, a tried and true method I explain in my best-selling book that is so opposite of what the financial world keeps telling you to do. And in the end, no matter what you might have, both for today and in the future, settle in on what the Apostle Paul learned about this notion of being content. In other words, no matter what the circumstances and no matter how much you have in the future or today, in Philippians 4, Paul reminds us of this, that we are to be content in all circumstances. And Paul learned this, to live humbly and to know that whatever was going on, whether he was full or hungry, he was going to be content. You know, this idea of living what I refer to as the flat-lined life of contentment, where our emotions about life and money do not go up too much when things are going good, nor go down too much when things are going bad, is living a true and healthy life, one filled with God's Spirit rather than being controlled by our flesh. So, dear Christian, the next time you fall victim to letting your emotions get the best of you, yes, even when it comes to investing in risky things you do not understand, you remember these basic principles, and I assure you, you will worry less about money both today and in the future. You got it? Well, good. So let me ask you a question. If we did go through another 15 years of flatlining stock market returns, would you be able to make it in retirement? Probably not. So the question is, why in the world would you be taking risk with your money at this stage of life, especially if you don't have to? Well, the only way to find out is to meet with somebody like me, Tony Walker, a trained retirement planning specialist who has literally orchestrated more than 5,000 written game plans. So to see if we might be a fit, here's all you have to do. Take advantage of something we call the free 10-minute fiduciary phone call, where you and I will talk by phone, and if I think I can be of help, we're going to meet in person. That's right, the owner of the company, to sit down and lay out this free game plan for you to review. Internet not your thing? All you got to do is call us anytime at 877-499-9255. Well, that's all the time we have for today. But you remember, between now and next week, if all else fails, you be worry-free and you make it a good one.